look, we had CPI come out today, and looks like both on headline, not that anyone really cares about headline anymore, but and as core as well, has basically come in below consensus, and we see a massive cross asset move. And so, can you just walk us through both of those? Maybe let's go through the CPI sort of figures themselves. Is there anything that popped out at you, and anything that we can kind of extrapolate from in terms of monetary policy out of the U.S.?
What a rally we have across right about everything today. And I guess the trigger is this CPI report, obviously. If we look at the details, I've been saying for quite a while that we should expect the prices of goods, so physical goods, to either disinflate or outright drop in the coming quarter or two. And I think if we look a bit beneath the surface of this core CPI print at 6.3%, that the goods component is the exact reason why we have a surprise to the downside of expectations for inflation. The monthly number is around 0.27, so month-on-month growth below 0.3% in the core inflation number. We haven't had such a low number since summer of 2021. So I guess this is a biggie for the momentum of inflation overall, and I think that's why we have this material response in markets. But let's look at the details. I mean, I've been saying that the price of goods needed to drop as a consequence of a reopening of supply chains globally. We have clearly lower freight rates from China to the West now. That's good news for the price of goods in a negative sense. We have demand destruction ongoing a lot of places around the globe. PMIs below 50 right about everywhere you look. So I think this is a natural consequence of an economic slowdown globally that we see this reaction in goods prices. But if we look at the price of services, the trend is actually still intact. The most important component of service inflation is the rent of shelter cost. It's up around 0.6% on the month. Basically the same kind of trend that we've seen in the shelter cost over the past couple of quarters here, which essentially means that service inflation is still moving up on a trend basis while goods inflation is moving in the other direction. So we have this theme of goods disinflation or deflation versus service inflation. And I think when we sort of boil the two trends together, that when the dust settles into next year, a new natural level for inflation is probably above 4%. That's at least what my models tell me. And I think in the light of a stabilized level of inflation of above 4%, the Fed's got a lot of work to do still, and we obviously got a lot of Fed members at the wires already.
Yes, indeed. Yeah, just to put some context in that, even before the CPI print came out, we had two Fed speakers who were saying, yes, they weren't obviously being dovish by any means, but they were being cognizant of doing too much or being aware of potentially breaking something. But however, we have a job to do, and that is to get inflation down. So I suppose that more rate hikes to just keep coming as of now, and then it'll just be how long they stay up is sort of the takeaway from this one reading, right? And is there anything that we can really take from this one reading, because one reading is certainly not enough, right?
Yeah, sure. I mean, let's take a step back and look at what Powell has actually told us in the past months. I think he's been clear that he's afraid of repeating the mistakes made, in particular in 1974 and 1975. What the Fed did in 1974 was that they made a very swift pivot as inflation turned lower. And the ultimate issue was that they made too swift a pivot to ensure that inflation actually stayed in a disinflationary trend. And ultimately, we got a double top in inflation during that period. It was obviously not only the Fed's fault, but the Fed was part of the problem in hindsight. And therefore, Powell has kept reiterating, we will keep at it. A direct referral to Volker's book keeping at it, basically meaning that interest rates will have to remain higher for longer to ensure that the animal spirits will not resurface as soon as we see these disinflationary trends that we do now. Because I think it's fair to say that the peak is in. I think we will have more downside in inflation in the next quarter or two. But I think the level that we should expect it to stabilize around is above 4%, or maybe even closer to 5%. At least if you look at the underlying fundamentals of various price surveys, etc. So the point here is that if these animal spirits resurface, as we see today, Nasdaq running at 7% gains on the day, we see renewed gains in crypto space less than 24 hours after the biggest blow up in the sector ever. I personally think it's a crystal clear signal to the Fed that they will have to once again reiterate that if we don't listen to them, then we risk ending up in a double top inflation scenario, and therefore they will have to keep going until we get the message.
Listen to us, do not fight us, essentially, right? Yeah. Thanks so much, Andreas. And then just real quick on, as you said, Nasdaq, plus 7%. That is obviously a massive move, but let's also keep in context, as I said yesterday on the Real Vision Daily Briefing, when crypto was blowing up and crypto was moving the Nasdaq over the last 2 days prior to that. We have to keep that in mind as well. A lot of that downside of the last 2 days was not derived out of equity indices, but rather out of the crypto space. So when you see a 7% single day move, that is, first of all, that's a lot of that is short covering. Yes, there's going to be some new longs in there, but it's also basically kind of getting back into equity markets and moving on their own merit rather than another asset class like crypto as well. So all of that stuff to keep in context. Now, the framework is that the world works and asset markets and all that are essentially moving and are priced off of or driven by these enormous flows of capital of existing debt that need to be rolled over, and the capacity and ability to do that. And with basically a shortage of collateral and sort of volatility and illiquidity, you're going to have some massive problems coming up, such that you're going to have a potential central bank or a Fed pivot or a Fed pause, if you will, in their tightening regime that they're currently doing sometime around, was it Q1, Mike? Next year, Q1, Q2, somewhere around there?
Yeah, my estimate's been by Q1 there'll be a move of more liquidity back into markets, and that increase in liquidity is clearly going to be good for longer duration assets. And as I said before, the thing to watch are cryptocurrencies. That's not investment advice. It's just basically looking at them as a barometer. They're hugely liquidity sensitive. If there is illiquidity, they go down. They cascade down, as we know. If there's more liquidity, they will just trend upwards. So be a trend follower in these markets.
Right. So yeah, if you want to go out on the risk, all the way out on the risk curve, especially given the last week of the sell-off, if you want to participate in this sort of reversals and an upside in risk, come this pivot that will come as a result of things breaking in illiquidity in treasury markets, going long crypto or sort of zero cash flow Nasdaq stocks would be the play in which to do that. Obviously not trading advice, just the way that things were basically the last time that this sort of setup had occurred. Do I have that more or less correct, Mike?
Completely correct, 100%.
Amazing. Look, thank you so much. I definitely need to get you back on again, and we'll talk more in depth about BOJ, the U.S. Treasury, and currencies, and cross-border and no pun intended, cross-border and cross-asset flows and all that. But to everyone else out there, thank you for your questions. Thank you for watching the Real Vision Daily Briefing.